Fed's Yellen downplays long-term inflation risk. Federal Reserve Chair Janet Yellen is downplaying concerns about rising inflation despite recent signs that price increases are picking up. Consumer prices have risen 2.1% in the past 12 months, the Labor Department said Tuesday. If maintained over time, the rate would exceed the Fed's target rate for inflation of 2% and signal a potential need to raise short-term interest rates from near zero. Higher rates could possibly limit economic growth, but at a news conference, Yellen is suggesting that rising inflation may prove temporary. The data we're seeing is noisy, she says. Okay, my initial comment on this is how she's looking at the data, I really don't know. Because if you looked at the past, I don't know, 4, 5, 6 years, we're seeing much higher inflation than 2%. Because remember, the CPI is a rigged figure. The CPI does not include the inflation that is in the stock market, in the bond market funds, etc. So if you look at the CPI numbers, they're inaccurate. But the numbers that she's looking at, the 2% threshold, well, if you want to look at that 2% threshold, you have to first look at the fact that how could she potentially be right? Out of a blue moon, how could she be right? Some people may say, what the hell are you talking about? Well, like I've been saying time in and time out, if China blows up, right, which I think is going to happen in the next few years, then you're going to see deleveraging going on, and it's going to affect the worldwide economy. This is not like Argentina. This is not Uruguay or some third world country where there may be a temporary problem in the world, but they could have some backdoor deals to try to alleviate the pain. If China, a 100-pound gorilla in the room, blows up, then all of us are going to face some sort of economic downturn. I mean, some may prosper, obviously, but the most are going to face some difficulty. And now we could look at maybe somewhat of parallel to 2008 and look at the oil market, and let's tie everything together, what's going on in Iraq. The rise of a major oil spike is now the highest since the financial crisis. This is from the Business Insider. Let's look at it. And this is actually from the Reuters, but Business Insider covered it again. Iraq will be foremost in investors' minds in the coming week as oil price risk has returned to markets, complicating the task for central banks whose policies are beginning to diverge for the first time since the global financial crisis. Oil prices neared 9-month highs late last week, touching $115 a barrel, and the rapid advance of militants in Iraq, the second largest OPEC producer, is destabilizing oil markets. That has implications for inflation in the United States and Europe, as well as Asia's export-oriented economies that are large net importers of oil. Investors will be watching a range of data, and it goes on and on. But then it goes on with the quote, although high near-term inflation may reduce the likelihood of more ECB easing in the short term, lower economic growth and core inflation down the line, in fact, support the case for further accommodation at a later date. So they're accommodating Europe, they're accommodating here in the United States still with 0% interest rates. And Iraq is on the verge of becoming radicalized, which was the intention, not the intention when we went to Iraq. So what's going on is counterintuitive to what George Bush and these guys in the Republican Party told us. In recent memory, the last time you've had an oil spike in the summer, you had to look at 2008, right? The year the market crashed. I'm not saying that the market's going to crash this year. What I'm saying is this is like the last time that we've seen a dramatic, or we could potentially see a dramatic rise in oil prices. Right now, oil has gone to $108 a barrel. Earlier on this year, it must have been close to $92, $93. I was trading oil ETFs, and I said, I'm getting out of it. But anyways, with the Ukraine situation, I said, I'm stopping around that time. But anyways, 95 earlier, in 2008, it went to like 145-ish. This chart has it from the St. Louis Fed site at 133, but it was like 144, close to, I don't know, June, July, sometime around there. And this is WTI. So if you want to go to right now, if we continue to see the trends like we do, let me pull up a graph of that. Alright, and we could go to this year. So like I showed you, it was like February in 2008 where gas prices were like 95-ish, right? And if you want to look at February, it's like 96-ish, okay? So from 96, it goes all the way up to 107.5, $108 a barrel, which is quite high for June, right? I mean, one way of looking at it is that you could see oil prices spike until July 4th. You may see oil traders saying that, hey, you may have a lot of individuals travel a lot during the July 4th weekend. They could run it up maybe $5-10 more, and then it's just going to be in a sideways consolidation pattern. We shall see how it goes, and maybe the Iraq situation is going to die down. Could be a scenario. Or we could see another oil spike. It could go to like 130, 140. If it does that, we're in definite recession territory, right? Using the phony baloney government numbers. But if you want to look at some other charts, retail sales, this is quite interesting. Alright, I'm at stocktwits.com. I saw this from a link from Panama Orange, and this is quite interesting, right? So let's look at this to the side. The last time retail sales growth fell in such a narrow manner for 3 years, it kicked off the 2008 crash. Recent stagflationary spikes in gas, groceries, and utility bills should be a final catalyst to kick consumer back to the grave. And I don't doubt this story, because at the end of the day, what do we have? We have the problems with Obamacare, higher prices for healthcare. You have higher bills for groceries. You have 3, higher oil prices because of the Iraq situation, and not to mention the fact that higher oil prices leads to higher prices in the interim, right? Unless you see a huge dramatic fall. So if it goes to like 115 and then all of a sudden 5-6 months later it goes to 95, Vincent Reinhart, an economist, he's the husband of Carmen Reinhart, he made a study saying that if you see oil fluctuate like that, then it has no impact on GDP. But if you see oil prices go up maybe $20-30 more, it stays there for an extended period of time, then we're going to definitely see a recession, or we're going to see stagnant economic growth. So if you want to look at that, 2008, we remember what happened: retail sales, the whole economy, stock market, everything. So is this a precursor to a lower stock market at the end of the year? We shall see, right? The stock market has climbed up. Many people have been surprised, but would I aggressively be buying the stock market at these highs? No, I wouldn't. And I am short some of the stocks out there and some indices. But I'm looking at it from a 2-year standpoint, right? 2-3 year standpoint. I'm not looking to make a buck in the next day. I'm not a professional trader. I just want to let people know that. But anyways, you see these charts, right? What does that tell you? It tells you that retail sales are most likely going to continue to collapse. You're going to see higher oil prices with the charts that I showed you before in other videos as well. But now the question is it going to be taking a course of 2 years, or is it going to happen all at once? Now that shall remain. I did mention in the other video that, guess what? You have the Iraq situation, but that could potentially be a dress rehearsal for 2016. Remember, these elite, right? They always plan things in 8-year increments. If you look at 2000, 2008, and then 2016. You also saw an increase in margin debt during those times. You see margin debt in all-time highs. So what I'm looking at is the stock market will fall in the next few years. Margin debt's going to fall. Consumers are going to get hit. But the only reason why the stock market and the economy, as all these mainstream pundits are saying, is going up is because you have all this easy money floating around. And since you have all this easy money floating around, governments can continue to fund all these ridiculous programs, such as the student loan program. Also subsidizing the car industry, right? Via subprime loans. And since they're subsidizing these industries, you're seeing the most growth in government in those sectors, which is crazy, by the way. And I've done videos on that. So you're starting to see the student loan market starting to get out of control, and that's going to blow up. Even Mark Cuban's talking about it. So there you go. This is the central planning dream, right? And it's going to end badly, obviously, and next few years, not going to be pretty in my opinion. Could we see Dow maybe 11,700? Yeah, that's what I end up seeing. In addition to that, I do see us facing potentially a Japan-like scenario if they decide to do bail-ins. Who knows what they're going to do. But then after that, we're going to probably see a new currency paradigm. But anyways, guys, thanks for listening to me. I'll talk to you later. I'm most likely going to be busy during the week, as I usually am, so I'm trying to do videos once a week. That's the goal for now, and if I get more time, I'll do more videos. Thanks for listening to me. Talk to you later. Bye.